Welcome back to the Bull Moose Podcast, the number one niche dental CPA podcast in the world, according to us at least. The last few episodes, we've been talking about practice transitions, and we're happy to be joined today by Sean Epp and Joe Friction of True North Dental Transitions. So they're in the brokerage game. They're here to be able to give you a different perspective of what the dental market looks like, what some mistakes they see that are out there, what you should be looking for if you're a buyer. So we're happy that they're able to join us. And if you guys want to start out, just tell us a little bit about your company and some of your background.
Sure. I started True North Practice Transitions back in 2013, and my background is I'm an attorney and a practice broker. And so we try to bring a kind of some of the legal background as well as kind of that broker background to all of our practice transitions. You know, I come from a family of dentists, so I've always been in the dental industry growing up and at least adjacent to it. And so it's great working with dentists for my career.
And then, Sean, I mean, you have a breadth of experience from working at the DSOs. What a little bit about your background?
I've been involved with kind of the buy side of group practice or DSOs for the better part of 25 years or more, working with several different regional and some national players. So I've kind of been on the inside, if you will, and kind of know how the sausage is made. And originally before that, I'm a reformed banker and private equity deal person at my core, which was my experience prior to getting into the dental industry. One of the first equity investments we made as a firm was in the dental management space. So that was circa 20, or not, it was 2000 actually. That was when I first kind of dipped my toes into the dental waters.
Excellent. Well, I think, just starting out, you hear a lot of stuff about DSOs are going to take everything over. If I'm a young dentist and I'm looking to buy a practice, our opinion is it's still a good investment to make. What do you guys think about that?
Joe, you want to go?
Sure. Yeah. I mean, ultimately, owning a practice, allows you to control your own destiny. Not only making decisions and running the practice how you want to from a supply perspective, procedures that you provide. It also allows you to, have a larger income and, and provides other tax benefits, which Mike, I'm sure you've talked about on, other podcasts that you've had. And so what we find is that a lot of doctors who are buying practices, they really want to take their career to that next level and be able to run their practice how they want to. So it definitely makes a ton of sense.
Yeah, and I still think dentistry remains a fantastic industry for doctors that are more entrepreneurial in nature. I think it's still a wonderful career opportunity. I think if anything has really changed over the last several years, I think maybe the bar has just been raised from like an execution risk standpoint as a practice owner. Between insurance companies doing no one any favors and just the rising costs of staff, specifically hygienists for general dentistry practices. Those have been challenging, but none of this is news. And I think while there are legitimate criticisms of a variety of things, the reality is that comparatively, dentistry is still a very high margin sector, which is why I think it still remains a great career opportunity. And it's also why it attracts so much investor interest. It is the profitable nature of it. And it provides opportunities for all sorts of other, ancillary businesses like accounting, like legal, like consulting that participate in the ecosystem.
Well, and I think we've always told clients when they've been nervous about it, I don't think we've ever had a client who's gone out of business in dental. We've had restaurants and things like that have gone out of business, but dentistry still, and we've all been around long enough, you hear every couple of years that DSOs are going to take everything over, and it never happens. It seems like there's always a lane for private dentistry, just
Well,
as there's for
and
private
DSOs
accounting and all that stuff.
DSOs, it really comes down to the choice of the doctors. If dentists want to be practice owners, and they don't want to work for a DSO, then, DSOs won't take over. And we definitely see that in the dental industry, that they are a very safe business, and the failure rate on, dentists who buy practices is so low, and I hear that from a lot of the dental lenders too. I talk to the various lenders, and there's a reason why there's so many dental lenders out there, because it's such a safe loan. It's such a safe investment from the lender side. And
Yeah, it's one of the few industries you can get 100% financing for your purchase, and then get a line of credit and a credit card and all the things you need.
Yep,
Every other business, you're putting 20% down.
exactly.
So,
Yeah, I'm sure if we had bankers on the phone, they could quote this chapter and verse. But I think defaults in this sector are extremely low from a payment default standpoint. So write-offs in this category are typically pretty low for the banks. Happy to be corrected by any lender out there. But I think that's why, as a category, it's perceived to be, because it is a pretty durable, safe investment.
yep, absolutely. I think one of the trends that we've noticed that still seem to be going on within dental practice sales, really since 2012, when the fiscal cliff was happening and some people got motivated to sell their practices before they thought capital gains were going up. Our opinion has been dentistry's been kind of on a bull run still, where practice values have remained relatively high compared to historically. We always heard the norm of a practice would sell for 60% of its collections. Is that kind of what you guys are still seeing? Kind of I wouldn't want to say an inflated market, because it's a willing buyer, willing seller, but still seeing prices on the premium side?
Definitely. I mean, practice values, purchase prices, they've all been going up and up and up. And we've seen, even when interest rates, they were so low right after COVID, in 2020, 21, we were seeing very low interest rates, and then they went back, then they went up. We were seeing interest rates in the 6-7% range. And those, even when the interest rates went up, we never really had I didn't see like that would take down practice values. It really just, that market just kept going. And we're even seeing now some of the lenders are changing their credit policies around to support higher purchase prices. And, we keep pushing on them to allow for a higher value, because, these really good practices that are highly profitable, they deserve a high purchase price and a high value.
Well, yeah, I was going to add, I'll zoom out for a second. One of the questions around kind of the DSOs, are they going to ruin dentistry, or wipe them out, etc. They're not going to wipe anybody out, to be clear. Roll-ups and private equity funded roll-ups in particular, they're nothing new or special. That playbook's been around forever, and it's been applied to every sector that you can imagine. The way, being a reformed private equity person myself, the way I think about private equity and its role in our kind of business ecosystem again is, it's simply the most expensive money any business can borrow. And it's almost less than the financial cost than it is the control and governance cost, is how I think about it. It's rental equity. I've heard one person call it requity. It's a temporary chunk of capital that's expecting to make a rate of return, and then it's going to move on to its next opportunity. And so I don't think there's anything intrinsically good or bad about private equity. It's just another piece of capital that can facilitate deals. I think probably the most important thing, and this is more of a diligence question, which we might get into, is if you're going to consider a group exit or a DSO exit, I really encourage doctors to spend as much time as they can understanding the people and the culture of that business. That is almost, to me, more important than the numbers themselves, because those tend to trade within a pretty tight range. I think one of the deficiencies in diligence for sellers these days is not spending enough time. What's the term from banking? KYC, know your customer. In this case, kind of know your buyer. How well do you know them? What do you really know about their financial health and well-being? And this, I think, is particularly applicable if you're being asked to take either significant credit and or equity risk on the buyer through seller paper, earnouts, or of course any kind of equity rollover or reinvestment.
And I think that builds on one point or a question that I had where you guys come in as brokers in terms of helping people evaluate offers. What are the biggest differences you see between a private person who's coming in and making an offer and the DSO? I mean, because we have a lot of, I think the one big thing that has changed is younger clients willing to sell because they have this fear of missing out on some magical multiple that a DSO might be able to offer at some point. Can you kind of describe the difference in those particular buyers?
Yeah, I'd say that, it's all about the strings attached. If you're going with if you're selling to a DSO or a group practice, there are going to be a lot of strings attached, meaning work back requirements to work, 3 to 5 years post closing, equity, you're required to take some of the purchase price, your enterprise value, and take that in equity in the DSO, promissory notes that are tied to the collections of the practice and or the EBITDA or the profitability of the practice. Sometimes they'll encourage growth. You'll get a little bit more money. And a lot of those payments then are strung out over a period of time. For a private doctor who's going to be coming in to buy that practice, our expectation going into it, like Mike, you had mentioned before, these lenders are providing 100% financing. So we're expecting that purchase price to be paid upfront in full at closing for the real estate and for the practice. Occasionally there are seller notes in the private buyers transactions, but those are more of an exception or a smaller portion, and usually there's a reason for that. And so you get a little bit less of a the purchase price overall will be a little bit less on a private doctor, but you're getting all that money up front and you're not going to have any strings attached typically, whereas you would have those strings attached on selling to a DSO or a group practice.
When I think one of the promises that DSOs are making when we're seeing these hybrid approaches is that they're going to be able to recapitalize, and if a regular dental practice sells at a multiple between say 5 and 7, that they're going to be able to get it to 10 to 14. How realistic do you guys think that is, given the fact that, I mean, dentistry is we just got done talking about it being a very good business to be in, but there's certainly some key person risk in terms of a dentist is going to be producing most of that revenue. I mean, is that 10 to 14 multiple? How realistic is that? Are you guys seeing deals out there at those numbers?
Well, that's probably the biggest learning opportunity in a lot of these processes. I mean, if rewinding the clock back to the early 2000s through the mid 2000s, I mean, you could buy private dental clinics for 3 times EBITDA or less. And you could do that forever. And your incurrence tests for the groups now, they could borrow up to 7 times EBITDA. So you could seed a platform, and then do all your M&A exclusively debt funded, which sounds counterintuitive to people in the LBO world, but that's how that worked for a very long time. And one of the big things that has changed is that, well, a couple things. Number one, private practices just trade for probably double what they used to 20 years ago from an EBITDA multiple standpoint for the healthy ones that are kind of group eligible nowadays. And the platforms themselves are no longer recapping, for a variety of macro reasons, no longer recapping at these lofty mid to upper teens type valuations. So you've seen a significant compression of the bid-ask spread between what you used to be able to buy private practice for and then recap the platforms for. That used to be north of even 10 times the arbitrage opportunity. I'd say that arbitrage opportunity is more than halved, if not more, for most buyers.
So yeah, and a lot of this, a lot of it's unknown still. I mean, a lot of the DSOs are promising these big returns, but the explosion in DSOs really happened within the last 5, 6 years or something like that. 2019, 2018, and now going forward. And so a lot of those recaps are going to be happening. Their expectations are they're going to be happening here in the next year or two or three, and we'll see what happens. It's a unknown. I'd say it's an unknown market at this point.
Yeah, I mean, and that's what we would say. I mean, we've had clients who've had the experience of selling out to these models where we have not seen the recapitalization yet. It may be early in the process. It strikes me as a business where, yes, it can sell at a healthy multiple, but could it sell at the same level of a business that might be making widgets somewhere and doesn't require skill and get that kind of multiple? Seems a little far fetched to me.
Well, and
Well,
some recaps have happened. I mean, it's not like this is unknown. I mean, they
Right.
are, there's been some recaps and some doctors have done very well. So this is not, but what we don't know is now that there's that there's been a lot of acquisitions by DSOs buying up practices and their penetration in the market is larger. How many, how much new money is going to be coming in to recap these? That's the open question. Sorry, Sean, I interrupted you.
no. I mean, sure, these businesses are still getting recapitalized. Now, the sector is one of the more underperforming sectors of late, especially from a credit health standpoint. There's a broad swath of group practices or DSOs out there that are significantly over levered. Anyone can Google this. There's been some significant recent restructurings of relatively large DSOs, which people can run down. I think it's also important to understand, if you look at the sector really since kind of post-COVID, whatever that means to you, the sector has been relatively underperforming as a cohort. Those vintages of recaps or newly formed group practices from the early 2020s are not performing very well as a category. They're almost universally over-levered. And so I think the real question is, how do you wrap your arms around the proposed equity value and its growth? And that's where I think the right advisor can help someone tease this apart, because the sponsors, the private equity firms of this industry, have been underwriting transactions, recaps, or new business acquisitions as low as 2 times cash on cash over their investment hold period, which is usually parked at 5 years. And so backing into the math, that's like a 15% IRR, just quick math, over 5 years. And so I say all that because if someone's whispering in your ear, suggesting you're going to get 3, 4, 5 times your money, that's probably a good time to get extra curious, because how do you make that kind of return when the sponsors themselves are looking at 2 times cash on cash? Because nobody beats the house, and private equity is the house in that scenario.
Your guys' role as brokers out there, I mean, brokers, there's always a mixed opinion about them. I mean, back from the old days when Paragon and AFCO were doing dual representation, what is your guys' role? Why should a client, if they're looking to sell a dental practice, use a broker? And in particular, your brokerage.
Yeah. So we're a bit unique in that we are a half law firm, half practice broker. So what we bring to the table is providing that legal background and as well as knowledge of the market and our network. So what we bring to the table, and I think why you want a broker, is to make sure that your practice is exposed to as many potential buyers as as we can, to maximize that, because the more buyers you have for a practice, the more potential higher purchase price or better overall terms. And that goes for the private buyer or for a group practice or a DSO. And so what we do personally, for our firm, is that we also have that legal side of things, so that when we're negotiating a letter of intent, we're negotiating all aspects of the transaction. So not just the financial, but also the legal. And, we want to make sure that they're connected with good accounting firms, good CPA, so that they have that tax, and so that we can, be more comprehensive in that negotiating of the letter of intent. And, and our jobs from the brokerage perspective is really to have as broad of a network as possible, so that, as I said earlier, that we can expose your practice to as wide variety of buyers as possible.
Yeah, and I would add to that, why choose us? I think in particular, so most of the work we do is going to be for your traditional doctor to doctor transition. That's the core of what we do day to day. Joe, correct me if I'm wrong. Where I think we can add unique value is on any practice that first and foremost will fit into a group strike zone in terms of size. So it needs to meet the kind of the strike zone requirements of the groups, but then more importantly, the doctors themselves have to be open to a group exit. There's no point in pushing rope if a doctor is not interested in a DSO backed exit. We just got to take their guidance on that. If they are open to it as an additional, exit path, hopefully we're there to help guide that and make sure they're obviously getting the best possible terms. And I think where we can really add value is pulling apart the junior capital components of any offer. So what do I mean by junior capital? That would be certainly any seller notes or paper the selling doctor's taken back where they're taking credit risk on that buyer. Any performance-based payments, earnouts, etc. And of course the equity component. If you get 5 offers, the total enterprise value could be identical, but they could be wildly structured differently. And understanding how much of that, if you had to kind of risk weight the capital stack and really look at that kind of that implied value, that's where I think we can really make a difference to help doctors truly best understand or compare multiple bids from groups.
No, and I think that's a very important component because, quite frankly, I mean, compared to the old days, there used to be this, kind of theory, well, I'm never going to sell it to a DSO, but then all of a sudden, sometimes the money truck backs up and people's tune changes, and being able to assess those opportunities versus blindly going into them, I think would be of great value. Can you guys talk a little bit, if you're a dentist and you're trying to maximize the value of your dental practice, what are the biggest drivers? What should they be doing in terms of increasing the value of their practice? Let's say they're 5 years out from selling.
One easy thing to do, I mean, ultimately profitability is and EBITDA and, having that, continuing the growth from a revenue and keeping overhead kind of in line, that's going to increase the value, like no matter what. Every dollar of profit that you gain that you have in your practice is just exponentially helps the value of the practice. But one thing that I see that is an easy fix, sometimes or increasing profitability can be difficult, but one easy thing is to have a really clean financial statement. And especially if a practice has multiple locations, but that clean financial statement where we can run a financial statement and not have to make a lot of adjustments to understand what's going on. That is critical, and it's something that is fairly, it takes diligence. Having a good bookkeeper, having a good CPA is really important to keeping those financials clean. But that's a really easy thing to do, and but it takes some time, because if you're 5 years out, if you do clean financials for the next 5 years, it's really then easy to look at that financial history.
Yeah, I mean, I think the old adage of what is it, plan the work, work the plan, still applies. And for owner dentists who working with their accountants and their other advisors, understanding if I look at the outside peg as a 5-year exit, what do I need to do working backwards? How do I reverse engineer that outcome, basically, and plan as much as anyone can for it? I think it's also a good reminder that maximizing growth and maximizing margin are kind of diametrically opposed forces. And so just being cognizant of that, and as you look at, are you going to expand your facility? We've all seen some of the bad outcomes where someone does a substantial facility upgrade or upfitment renewal of their practice contents and technology without any real payback. They do this inside of 2 years, sometimes even 1 year of a sale. There's all sorts of adverse tax implications, etc. So anytime you can be more planful than not is better, I think. And I don't know if you had asked about this question more in the context of growing a small group or just a single practice, Mike. But I was going to add that the biggest gap I've seen on the small group side and when people go to look to transact is that it's a human capital deficiency. There aren't enough bodies around the table to truly function as a going concern business. It's probably a scenario where you've got a producing owner dentist who's burning the midnight oil to also run the business. And so when you go to do your fully baked pro formas, most buyers will quickly identify and realize and price in adding substantial overhead people to ensure the operations of that business that they're acquiring. Whether they tell you that or not is a different matter, but that's how they're looking at it on their side.
So
And I think, go ahead.
we like to do though is bring clients in at that 5-year mark, even out to we've done as early as 7 years before they're ready to retire, ready to sell. And what we like to do is we might not be doing a full practice valuation, but what we will do is we go through the financials. We'll look to see what's going on from an overhead perspective, and then we try to give advice. We're not business consultants, so we can't actually fix the problem, but we can identify certain areas that we see that one category of expense might be a little high, one might be a little low, and then give them some strategies or at least connect them with people to fix if there is an overhead problem. And being proactive for us is getting where we're starting to talk to them at that maybe 3 to 5 to 7 year mark is really that sweet spot where you still have time to make changes to the practice, and then give yourself the runway to allow those changes to benefit and show in the financial statements for the next couple of years before a retirement or before a sale.
So that brings up kind of two things is in terms of value. Is there kind of a sweet spot in revenue that a solo owner can be at that makes it more marketable? I think what we generally would tell clients, if you were somewhere between 1 million to 1.5, you probably have the widest swath of buyers because you not only have you're not too big for the private buyer and you're big enough for the DSO. Is there a revenue area that they should shoot for?
Well, yeah, a lot of it also is the hygiene component to that for a general dentist. Specialties can be different from that, but for a general dentist, if we want to see that hygiene to be, at least 25% to a third of the total collections of the practice. If that hygiene is a small percentage of the revenue, that means typically that the doctor's doing a lot of specialty work and or procedures that a new buyer can't do on the doctor to doctor side, or on the DSO group side that again they're looking to eventually replace that doctor, that it's going to be hard. So if we look to see that 2/3, 1/3 split of doctor to hygiene, that's a big, that ratio is going to really help and create a wide variety of potential buyers. But then I'd agree with you though, the 1 million to 1.5, maybe even I think it could go a little lower than that, 900,000. Once you get below like 750,000, I'd say, then that's going to start turning off some buyers because they're looking for a bigger practice. Typically the doctors who are buying practices. Same thing with the group side. If you get too high, then again, from a doctor to doctor perspective, the young doc can't do those procedures. They don't have the efficiency, at least not yet, and then we need to figure out solutions for that. But yeah, 1.2 to 1.5 and creating that good hygiene to doctor ratio of 2/3, 1/3 is
And I think, the hygiene ratio is a really important point, that it just shows the sustainability of a practice. If that number's off, there's question marks.
Well,
Sean, you go ahead.
I was
Sean.
going to add, I think the one metric that doesn't get near enough time is simple patient numbers, truly active patients and new patient flow, because it's really hard to make sense of any of these numbers without any metrics or ratios to understand comparative returns. And so, a healthy number this will be for general dentistry clinics. Good enough for what is a full-time dentist in most models? It's going to be a 4-day-a-week, 32 clinical hour a week doctors. What do you need? How many active patients do you need in recall to keep your, again, I hate to use averages, but your typical general dentist busy enough for themselves to be making the kind of money they want to make as dentists? About 1,500 has kind of been the number, and that hasn't changed a lot over the years. 1,500 active patients supports 1 full-time dentist and supports 2 full-time hygienists. Are kind of the quick math that most groups look at from an operational standpoint. And then on the new patient side, it's going to be. I've always only looked at ADA 150s. That is your comprehensive exam. That is a true new patient. It's kind of the purest number I've ever been able to arrive on. And what's a good number there? About 25 new patients per month for that same 4-day-a-week doctor practice. That seems to be able for that practice to maintain stasis from a patient flow standpoint, so you're not walking backwards. And then adding on to that from the hygiene element, one of the more common themes the last several years has been, of course, hygiene costs, hygiene turnover, backfilling for those people. We talk to a lot of doctors that start doing their own prophies or just resign themselves to living in the temp world. And I always encourage folks that, whereas hygiene as a department, if you want to look at it that way, was always a profit center for most dental practices. That was kind of the engine in a lot of practices. That went from a profit center to, in some cases, a push to, in others, maybe even a loss leader. And I think that's what lends doctors to say, well, why hire another hygienist if I'm just, pushing rope? Well, obviously, what's missed in that is you're not getting the at-bats to sell restorative care and treatment plan for restorative care that's coming through those hygiene columns. And you sort of got to complete the thought and then think through, because the worst case or the worst place you can be in, I think, as a doctor is seeing a runoff in your active patient load, which is you can usually see in your new patient numbers. So that means you now have an actively shrinking practice. And that can really put downward pressure on valuations.
When you guys look at active patients, because you see it all over the place in terms of how people determine it.
Yep.
What is your guys' metric for it? I mean, I've seen people as if somebody's come in the last 10 years, they're active, and that doesn't seem like a good measurement for it.
I'm happy to send it to anybody. I use the methodology that I've used in several different places that basically makes it software agnostic. You're just dropping in ADA unit volume codes for a handful of different ones and looking at the frequencies, and that gives the kind of the best number for me, and that makes it very easy for me to compare any practice to another regardless of software. So you're not debating, well, how did Dentrix calculate that versus Eaglesoft? I don't care. I put it in a common language.
So you're looking at prophies or things like that?
Yep.
Or
Prophy, perioactivity, the standard stuff. Yep.
Okay.
Nothing exotic. It really comes down to, for example, a good compliant patient should be coming in every 6 months for their hygiene recall. Well, we learned over time, over hundreds of thousands of patients and years and years and years, those compliant patients actually show up about every 9 months. Even if you book them again 6 months out, day of service, they invariably move that for one reason or another. It just gets moved.
No, absolutely.
So
Yeah. We still look at the active patient reports that the softwares, the practice management softwares will spit out. But we definitely need to, we always have kind of we look at a sharp eye at those numbers.
Yeah, and they all arrive at sort of the same numbers. You rarely have a massive deviation. It's just another way to look at it to kind of triangulate around the health of the patient base in any practice.
So if you're a buyer going out there looking to buy a practice, and what are some of the things they should be defining or looking at to determine whether or not it's a good practice for them?
I mean, number one is going to be location. They want to buy a practice in an area that they want to live in. With commuting, within reason, with a reasonable commute. Because once you buy that practice, you are now locked into that general location. You can always move a practice for, a little bit, but you can't move it 3 hours away because the patients aren't going to follow you. So, finding that practice, that overall location of where you want to live is number one. Other than that, I think that I mentioned it earlier, but that good hygiene to doctor production ratio is really important. A lot of and then that the active patients it's all kind of related, but a lot of, like, if it's a overhead practice, overhead is too high and the profitability isn't there, that can be changed over a period of time. That might just result in a lower purchase price on a really attractive practice. But making sure we have that patient base, and then having that good, and it's all, those are related, the active patients and then the hygiene revenue. If we can get those two things in line, like, that's, I love that right away. And then I guess the other one more piece is making sure that practice is going to fit into the procedure mix that the selling doctor is producing. We want to make sure that that's going to fit in relatively closely to what the buyer is doing. So if the seller does a lot of ortho, we need to make sure that the buyer is going to do ortho. If they don't do ortho, then we need to discount that or figure out a solution for that.
Mm-hmm. Yeah, I mean, I agree. I mean, I think regardless of buyer type, solo versus group, I think everyone's going to look at repeatability or sustainability of historical revenue and service mix. For group buyers specifically, it's mostly a function of recruitment. They're looking, do I have a reasonable chance of staffing this, nowadays both doctor and hygienist, over the long haul? And so you'll notice that most groups nowadays are not going rural anymore. They won't even go ex-urban. They're looking at truly kind of inside the beltway practices for the most part, especially the groups of any scale. I think you'll find some smaller, the groups that are still private doctor driven or emerging groups will take on a little riskier location type practices. Now, to be abundantly clear, rural practices are incredible opportunities for dentists who are willing to work there. I mean,
No, they're the best.
you can
There's
see
no
it. I
question.
mean, from any, it's truly a lifestyle decision, though. And I think if it'd be much easier to sell rural practices, but I think the reality is that just look at the healthcare deserts being created in general medicine. I mean, there's no reason to believe that dentistry is not going to follow suit. I'm actually more concerned, about long-term rural hygiene recruitment than I am doctor recruitment, because a lot of
No,
those.
I would agree 100% with that.
And even if a buying doctor goes to look at a practice and the equipment is older, I wouldn't worry too much about that. I mean, all that stuff can be replaced, equipment can be upgraded, and they'll be able to get financing for that. As long as it all works, the chair goes up and down, then they're going to be fine in the office. It might not be they're perfect, or the space isn't perfect. Those are all things that can be changed. And it doesn't need to be done right away. It can be done after a year or 2 or 3 years. As long as that patient base is there and that good hygiene to doctor production ratio is there, it's going to be a good practice.
Well, and that's a really good point, because we've just noticed, regardless of how nice the presentation of a practice is, when we have a buyer that comes in, usually by year 7, maybe by year 10, they've either maybe changed location because they wanted to get their own building, or they've completely overhauled the space to put their stamp on it, one way or the other. It usually comes, they pay off that first loan, and it's like, how can we put a little pressure on ourselves? Let's go take out another loan, to do some of this stuff. So I completely agree that some of the buyers who go out there and look too much at equipment, you're kind of missing the boat. If I'm a buyer out there and I'm dealing with you guys as a broker, what can I do to become essentially a good buyer? What are some mistakes you see buyers make when they come in that turn off sellers or turn off brokers?
Well, one thing, this is kind of adjacent to your question, is making sure that they are going to be financeable. So we try to get them in touch with some of the dental lenders as soon as possible, just to make sure that they have the ability to get a loan to buy the practice. And what that requires is at least they need to have some cash in a bank account. Typically 7 to 10% of the total loan value needs to be, that's the liquidity requirement the banks have. And so one mistake I see is we see a young dentist who wants to pay down their student loans as fast as possible, which I think that's great to pay down those loans. But if they take all their extra cash and they dump it into their student loans, then they're not going to have that liquidity requirement that the banks are going to look for. And so definitely keeping cash in a bank account. You can always it's not going to be used as a down payment, but it can be spent after the closing to pay down those loans, those student loans. But keeping that cash is really key. And then the other thing is, I think what I like to see when I talk to a young doctor is that they have an openness to learn about the practice, and find out, what they like about it, what they don't like about it, and not get really kind of tunnel vision. That has to be this particular. If I find a practice that checks 8 out of the 10 boxes and they say no because these 2 boxes aren't checked, that can put. I think that young docs are going to be losing out on opportunity. So being open to, if a practice fits a lot of their requirements, then being open to that practice. And then the other thing is having a good team. We want to make sure that they're connected with a good dental lender, a good dental CPA, and attorney, so that they can get through that transaction in a efficient and as pain-free as possible manner.
Yeah, and I think as from a group buyer perspective, things that are helpful that really have nailed down is certainly your equity story, if that's part of your pitch, and being prepared to actually walk somebody through your assumptions going into those returns that you're trying to sell them on, because there's clearly, the industry is clearly settled from my perspective into 2 camps: operators and aggregators. And so who are operators? These are groups that have been around a long time, have probably been, whether they're privately held, private equity backed. There's plenty, even in Wisconsin, there's plenty of closely held large groups out there. But they're people that have gone through serial recaps. They've gone through multiple refinancing events. They're proven on the execution side. And the aggregators tend to fall into the camp of they're EBITDA driven people. They're just trying to amass a big pile of EBITDA to turn around and sell an arbitrage in a transaction. And there's nothing wrong with that. That happens in every sector. But just understanding the differences there and how and the risks associated with that, because the aggregators tend to use maximum leverage, and it becomes about velocity of money, and they're just trying to get to that next recap before the music stops. And unfortunately for many of them right now in the current market, it stopped a while ago, and they're scrambling to find a chair or a wall to lean against.
One of the trends that we're seeing when you talk about DSOs or stuff is what I would say sort of the rise of the individual dentist who is looking around and now wants to own somewhere between, it could be anywhere between 10 and 15 practices on their own, or 5 or whatever. What are some of the mistakes maybe you see them making, or what are some of the things they need to think about putting in place before they try to scale at that level?
Well, everyone wants to tech enable and AI enable everything, and I'm not the old guy saying get off my lawn here by any means, but I think a lot of people lose sight of the fact that you need good managers, and really investing in your people and in your team. That's not to say go out and build out a 12-person support office with every functional department, but at least know going into it, you're probably going to have to spend good money on good people and be willing to do that to support the business, because your lenders are going to like it. First and foremost, it gives you more bandwidth as the business owner to shed a few of your caps as well. But probably the biggest challenge is they're too thinly capitalized or over levered, however you want to look at it, and they overinvest in technology as opposed to human beings helping manage the business.
And
Yeah, I would agree with that.
clean financial statements. especially I see this maybe not at the 10 to 15 practice level, but if someone is looking to go from one location to 2 to 3 to 4, it is imperative that they keep their. I've talked about clean financials a couple times here today, but having a clean financial statement where we can identify what's going on in each location is crucial. I see too many times where a practice has got 2 locations or 3 locations, and everything is dumped together, and so you can't really understand what's going on in each practice. Because a financial statement, I see it all the time on for the when you're selling a practice because people want to see the health of the practice, but it also helps you as a business owner. And so as when you get into the multi-location, you truly are a business owner, and that's a big part of the doctor's job. And they need to be able to see what's working in each practice, what's not working in each practice, and if everything's lumped together in one profit and loss statement, it you're losing out on all the information that's going on in the practice. And I definitely recruiting then is the number 2 thing. Just like the DSOs have to be, their main job is to recruit for staff and for dentists. As a practice owner who's going to be going from 1 to 2 to 3, they need to be, part of their job. They need to have the infrastructure in place to recruit, find new doctors, find new staff members, because there's just more turnover as you scale, and if you can't replace the people, then then the practice
It can fall apart pretty quickly.
Yep.
And I mean, we've definitely seen here in Wisconsin, there was a period of time where attorneys and supply reps decided, hey, I should own dental practices too, and they'd get to that 2 or 3 practices and it would all collapse at that point.
I think a lot of people made it look very easy early on because it sort of was fairly easy. I mean, you had that mass, when your arbitrage opportunity is 10x, you can stub all your toes and all your fingers. When your arbitrage opportunity is 3 times, your execution risk is just escalated. And I think for that small group doctor owner profile, these are inherently simple businesses in most ways. And so the only time you really have a financial problem post-closing is actually because you have a people problem post-closing. You either piss off the doctor, you piss off the hygienist, or you piss off the office manager, or some combination thereof. And that practice that might have otherwise been just fine or crab walk sideways for a while just takes a nosedive. And if it's a 1 doc, 1 or 2 hygienist practice, that key person risk is only amplified. And when those things go south, they can be very hard to pull out of that nosedive.
Wrapping things up, I mean, one of the things a practice broker is going to do is evaluation of the practice and determine a price. I guess twofold. How do you guys go about doing that? And I'm sure you guys get a lot of opportunity to review valuations. Some of the mistakes you're seeing in valuations out there.
Yeah, we typically look at practice 3 different ways. We look at the profitability, we look at the collections, and then we look at the hard assets, the active patients, the equipment, supplies, and in our mind, the collections and the profitability are the biggest drivers of the valuation. So we'll weight those heavier, so we try to look at because all those 3 methods of valuing the practice are going to tell a different story about the practice. Maybe it's got brand new equipment and it has a ton of active patients, and but then the profitability is lower, or the collections are lower. And so each of those methods are going to tell just different stories about the practice.
And I'm often, even if I don't express it publicly, I'm always looking at an effective price per patient as a going concern practice, because there's obviously a pretty clear standards been established for chart buys. Might be a couple $100, a few $100 depending on the market. But if you go back through a series of transactions, you look at what did we effectively pay per active patient, it gives you, it's not a decision maker in and of itself, but it helps me triangulate around, if you're looking at 5 different practices and everything else checks out, a revenue multiple, an EBITDA multiple, an SDE multiple, but the price per patient's wildly off. You probably know why, but it's confirmatory in a way, and it's a good gut check, because one of the things that happens frequently is a doctor will bring you a very established practice, but the two themes are a patient base in decline, like no new patients coming in, and they're doing disproportionately high charge per hours per patient. And effectively what they're doing is they're sort of crowning out their existing patient base. I'm not a clinician, so I use those words loosely, but you're basically doing an accelerated delivery of care for those restorative services, such that who's ever buying it and stepping in there next, you might have crowned out most of the available care in the patient base.
Yeah, there is a finite number of teeth, aren't there?
Yeah, well, I think people laugh at me, but you can't practice dentistry on teeth or patients that don't exist. So that's why those patient numbers are so important. And to your point, they're finite.
Well, I think getting back to Joe's point too, that why that hygiene ratio is so important, or looking at that as a predictor of the future. I mean, when we're doing valuations, we're trying to figure out what's going to happen in the future, largely by using what's happened in the past. So a strong hygiene base is this a critical element to that, and if you have that, the numbers you're talking about, Sean, should pan out.
And Mike, to address your question on the mistakes that we see, it really is on some of the adjustments that we see to the financial statements. One of the main reasons for doing evaluation is to fully understand what the profit of the practice is. So digging into the profit and loss statement, digging into the general ledger, and identifying what's actual overhead for the practice and what's discretionary or what's profit. And I see it going both ways. Sometimes I'll see a valuation that misses, a lot of expenses that are listed as expenses on the practice but are truly discretionary and might be a personal expense or something that is not needed to run the practice and the buyer won't have. So that would potentially lower the value because it's overstating the overhead and understating the profit. So that's bad for the selling doctor, but it goes the other way too. Sometimes I'll see valuations that are very aggressive in adding back expenses. But for example, say that if a supply cost is being run at 12% of collections or 15% of collections, I've seen valuations to say, well, industry average is 7%. So we're just going to reduce the supply cost from 15% down to 7%, which is going to understate the overhead, and overstate the profit, which would increase the value. When in reality, maybe the staff members are used to ordering, this particular supplies that are really expensive, or, the patient base is expecting a certain level of care, a particular supply cost, and that buying doctor is going to have that high supply cost, at least for a period of time. And if that's the case, then they're going to be buying a practice with that they're expecting a certain level of overhead, and then it's going to jump up, or it's going to, for what they forecast, it's really going to be a lot higher in overhead and lower profit. So being really careful about looking at those adjustments and making sure that everyone understands what those are, and you agree with them.
The other one I would add is that nowadays I probably quintuple check staffing costs. Probably the most common miss is getting deep into diligence and realizing, the LTM numbers suggest an overhead of X, but if you take a snapshot in time into the actual payroll you'd be stepping into day one, there can be a pretty significant discrepancy, and that can be for all sorts of reasons, of course. Turnover that's occurred over the last 12 months and the timing of that, and any resultant wage increases that aren't fully captured in the TTM versus the pro forma. So that's a big sell side diligence step, is to make sure we have that as zeroed in as we can. It's never going to be perfect, but if you can close that gap as much as possible on the sell side diligence, it makes conversations much easier with buyers.
An example of that would be a spouse who's working in the practice as an office manager, and the valuation says, okay, that spouse is not going to be retained by the buying doctor or by the DSO, so we're going to add that full salary back. But if that spouse needs to be replaced with a new hire, then you should not be adding that spouse salary back or at least you shouldn't be adding all of it back to the profit.
Well, and a lot of times the spouse is underpaid for tax purposes.
Right.
So if they're the office manager that should be making 75, they might be making 30, and that's not considered. Or, yeah, we'll see where they just adjust staff wages back to, well, here's what the norms are. And I would tell any buyer the hardest thing to undo right from the jump would be your occupancy expense, because you're going to have a lease potentially. And the second one would be you're not going to come in and go, well, guess what, everybody, we're cutting your wages because Joe and Sean said we're overpaid.
Exactly right.
So
And
it's gonna
that
take some
happens
time.
pretty routinely. We see that a lot.
Yeah, I was just gonna. You can make some fair assumptions, especially for group buyers, about what they can probably get their supplies and labs to. But again, that's sort of not your business. You don't necessarily have control of that. I think the bigger, again, going back to staffing costs, the bigger challenge and a big mistake can often be normalizing people costs for percentages of revenue. People don't get paid on percentages of revenue. So when you talk about reducing your overhead from 23 to 21% in a category, where are those 200 basis points coming from? Well, that's Becky at the front. Or, are you now going to reduce her hours such that she's no longer full time and then no longer eligible for benefits, etc.? Like, it's very dangerous to make percentage based pro forma adjustments around people costs.
I would agree 100%. Well, I want to thank you guys for your time. I'm going to get you out of here on, we'd like to ask a relatively fun question. You guys are from the Twin Cities, music hotbed. You got tons of groups who've come out of there, so I'm going to ask you your favorite Minnesota musical act, but you can't say Prince, because that's too obvious.
Well, Joe, do you want to go? You're gonna pass.
No, my favorite Minnesota band is Trampled by Turtles.
They're great. I saw them at the Pabst Theater.
They're
Down here.
fantastic. I've seen them multiple times, and they are my current favorite Minnesota band, and try to see them as often as possible. Some kind of indie Americana.
Yep.
Well, since you took away my pocket answer, Mike, I'm gonna go with the Moldy Man, Bob Mold, of Husker Du and Sugar fame, and solo
That's
fame.
who I would go with, Sean.
What's that?
That's who I would go with. Actually, my license plate is Husker Du.
Oh, is it?
So,
I didn't know
yeah.
that. Well,
HSKRDU.
sidebar. He went to my alma mater, McAllister
Okay.
in St. Paul. So, go Highland Coos.
All right. Well, I appreciate you guys being on, and until next time, we'll talk to you next week. It's the Bull Moose Podcast.